Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
All right, thanks very much. Good morning, everyone. Welcome to the McNichol & Associates Asset Management Research Meeting for April the 23rd. Quick update today from Grata, our real estate technology company, one of two in the fund right now, and then kind of a quick overview of charts of the week. As always, directing your attention to the disclaimer in front of you. So Grata put out pretty solid Q1 26 numbers, really building on their momentum. They secured and added $11 million worth of contracted revenue, and that brings the cumulative total to just around, call it $34.5 million bucks. Units stand at just over 27,000 and counting. They are rapidly acquiring units, so advisedly, anytime you get one of these reports, that number could be higher, and the annual recurring revenue at 3,380,000 CAD. The company is profitable, cash flow positive, and has over $5 million bucks in effective immediate liquidity on the books. The runway is 18 months long, and we're feeling pretty good about where they stand. This is just a look at the numbers in a table. Just helping out the growth trajectory were a couple of big wins for the company. Polygon was a major new enterprise win. They secured a strategic relationship with Polygon, and Polygon is one of Canada's residential developers out west. So it's a pretty big win for the company in as much as it's essentially functioning as validation for their ability to like if you'll recall a couple of years ago, they were kind of more focusing on mom and pop landlords, and now they're really getting into frontline meetings with sophisticated groups. So Polygon's one of them. There was a pretty significant portfolio expansion with Ironclad Developments, and that relationships looks like it's going pretty well. Sounds like they picked up 9 buildings in that deal. The one where maybe I'll get to TELUS in a moment. There's also a pretty big win in the Minto area. Minto, I think, was part of a take private transaction. I don't follow the kind of Canadian public REITs that much. But Grata was basically selected for Minto's flagship building, which is 61 Yorkville, and that's certainly one of Toronto's most prominent residential addresses. If anybody knows how I can get a condo there for a really cheap price, well, let me know. And what's nice about 61 Yorkville is, again, it's really upmarket. Like, it's a marquee asset. It's not some third rate rundown apartment building someplace else. So we're feeling pretty good about that. So let's just kind of finish off with TELUS. So that's moving ahead pretty quickly, and they are in kind of quite interesting talks with TELUS's leadership team, which had its own transition. I think Big Darren's gone, and they've got some new top banana there, but they were directly speaking with like the C-suite level executives, and that's very positive. And that's through the TELUS Living platform, which is essentially a white label, and it even goes beyond software development in terms of positioning Grata as the literally the tech engine behind TELUS's overall smart building and residential experience strategy. So you certainly didn't hear this from me, and I'm not saying anything, but that's going really, really, really nicely over at TELUS. And then just hopping over to charts of the week. Um, yeah, I mean, you know, the markets kind of were dipping lower in late March, and then they popped back up in April, and seems to be a lot of you know, focus on the ceasefire and oil. The extension of the ceasefire, and like this story could change. Like I was just getting gas about half an hour ago, and there was sort of one news report that came out on the ceasefire, and you know, I don't know if it's just sort of an ongoing story, much like cannabis. Sounds like he you know, moved it to Schedule 3 this morning, but that could take a few months by itself. Anyways, the ceasefire produced, you know, a decent bump in stocks, but you'll notice it didn't really starch oil too badly here, and it seems like they're waiting for some other catalyst. And I think right now, like the best thing you can say about the stock market is, um, it's it looks like the line of least resistance, as he says, in stocks is higher, um, but it's starting to get concentrated up top. So let's take a look at the charts here. So you can see that nice gap from the first downward standard deviation right up to the 50 days. So pretty much neutral in that context. And then same look over here. Um, the the thing that he points out in this chart, this is actually pretty interesting. Probably the most interesting chart in the deck. So anytime the S&P kind of, you know, explodes higher and breaches through all of these, you know, upper standard deviation bands in the very, very short term, like it sort of sets up a correction or a counter trend, you know, whatchamadoodle, and that's sort of in the short term, but longer term, it's kind of a good sign that stocks kind of have some punch to them, and so that's what you'll see here. Um, oil. So this is not WTI. This is USO, which is the United States Oil Fund, and you know the stock market is behaving. I think there's sort of this fatigue on Iran overall in terms of stocks, and you know the idea was that oil prices would kind of head back down, but then you heard stories that Iran kind of either seized a couple of tanker ships or fired a couple of shots at another container ship going through. And so the really interesting thing is that oil was trading higher not too long after it was announced that there would be a ceasefire extension, and so stocks kind of like flip flopped between that news. Oil, however, didn't really tank or spill, you know, pardon the pun, but the idea here is that there's this flaggish pattern action in USO, and you know, with the potential for the price to break from this pattern over the next couple of sessions. So I think it's just really hard to really make a long term kind of investment decision on oil right now. Um, it's more of a trading vehicle. So I think if you can trade the news, that's probably how you do it, which is really, really tricky. So this one's really interesting. This is the Dow Transports average. It went way up and then kind of came down. Almost all of that move is as a result of Avis, the you know, the rental car company. I have no idea what's going on in rental car land, but it seems as though there could be a short attack going on somewhere. That was sort of, you know, at the front end, all over the news feeds. I'm not really sure what the issue is. Again, I don't really rent cars often myself, so no comment. But advisedly, the bump in the transports and the subsequent sort of rolling over is pretty much all Avis, the rental car company, and then a blank slide, and then the Nasdaq. So pretty short deck. I'll pass it back to the team there. Thanks.
Thanks, Joe. Yeah, Ken and I looked at Avis the other day, and there's two guys who control a majority of the stock, like closer to 80 or 90% of the stock. And so they're just trying to squeeze out the short sellers who are Yeah,
Okay.
they're
No.
sold short like 110% of the stock or something crazy. Yeah,
Wow.
I went to try and buy some puts in my personal account, and no, they are way too expensive. So okay, Ken, take it away.
Awesome. Thanks, Dave. Just like always, just go over this little weekly report. April 23rd today. Canadian disclaimer for anyone located in Canada. Just contact us if you have any securities questions, and same with our US based viewers. Just contact us via our website or email, and we'll get back to you if you have any questions on securities advice. Just quickly looking here, S&P 500. It's been 2 weeks since we did this. It was out last week at a earnings day, but $7 increase over the last 2 weeks. Broke out to an all-time high, as you can see here. So really that weakness that we got in March, short-lived once again. It's kind of had that happen last year. Obviously more of the tariff tantrum, more of a plunge, but kind of following that similar seasonal trend. So 2 years in a row here where we've seen a bit of a rebound in the latter part of April, albeit it started a little earlier this year than last year, but nonetheless a pretty strong reversal. Vertical price objective moved up. It did break its longest negative weekly momentum streak since 2016 last week, and then overbought, oversold 61%. That's the highest since October. So some positive technical attributes here for a lot of these indices. NASDAQ here, $9 increase over the last 2 weeks. Strong 3 weeks for the market after, obviously, the Iran war pullback. This chart also broke out to an all-time high, breaking the resistance from December and January. Kind of a trend there with these growth-weighted indices. Price objective moved much higher to the highest I've ever seen, about 35,000 almost now. And it broke a long-term negative momentum streak on a weekly basis as well. Overbought, oversold 79%. That's also the highest since October. That's the third straight week it's been heavily overbought after that long streak where we were seeing pretty heavily oversold indice. Broad strength, obviously, in this rebound, defensive and some energy companies as well. So kind of a broad move, which is positive to see. The Dow here, a little less of a rebound, but it did create its third straight buy signal. So really gaining some strength, popping it back to a positive trend after reversing over this blue line 2 weeks ago. Price objective moved up to 50,000. Overbought, oversold 37%. And in terms of PE ratios, now more expensive than 1 year ago, but you have to remember about 1 year ago, we were closer to the bottom of those Liberation Day impacts, I'll say, from the market. So no surprise there. After the last few weeks, it's been less expensive than 1 year ago for the Dow. Looking at the TSX, $4 increase to an all-time high as well. Some of the rockiness, we'll say, in energy the last few weeks hasn't really, as a whole, it hasn't impacted the TSX, obviously, moving to an all-time high here and also moving up about 7% this year. Target price moved up higher to almost 2,300. Pretty cheap in terms of earnings still comparatively to the U.S. indices, and then overbought, oversold a little less than the U.S. indices, but still the second highest we've seen since the end of February. Looking at the VIX, you can see I just drew these on with hands, so pardon my penmanship, but we've gotten this reversal in recent weeks. Seen a bit of a perk up here the last few days with the SPY signal, but overall the trend seems to have broken. If they're continuously moving up since basically December, the past few weeks, we've seen a breakdown in the VIX. Nonetheless, with the recent increase, the target has moved up to 27%, which is right around this trend line. If it does pop above that, we could see the trend reverse, at least in the short term. Looking here, these are the charts that really have changed the last few weeks since we've last looked at this. Bullish percentage charts, both of them at 58% for the S&P and the overall NYSE, moving up 18%. So both at their highest points since they both are at 58%, but I just realized these two are the exact same charts. I think I put the wrong one in for the NYSE, but nonetheless, both still at the highest point since basically January, when the market really started to slowly turn over. So really positive. And then looking here at the percent positive trend, kind of the same thing. Both of these moving up pretty heavily after plunging in the recent weeks, sitting in areas where you're starting to get into that bullish territory above that blue line. Really positive market environment for the overall universe of the components for the Dow and the NASDAQ. So really we'll be watching those in the next few weeks. Not a lot of changes here, but we did get a reversal on the TSX, up another 4%. Have moved up about 10% off the bottom over the past month. So looks like some of these technical indicators may have bottomed for now. Looking in here, this is asset class rankings over the past 2 weeks. Commodities, no surprise, lost buy signals, really driven by energy, which lost 8 buy signals this week. Precious metals continues to pull back, just as investors rotate capital out of the asset class with the strong returns it produced last year. And then tech, first time it's gained buy signals in 5 months. So really something to watch there. But energy stocks continue to remain in the first position and really haven't lost any buy signals just because of the pace they were on. And some of the names still are performing well despite the volatility, with the price of oil trading still in the low 90s, high 80s, with really that geopolitical risk premium priced in right now. Looking here, like I mentioned, energy, we did see a pullback slightly. This is a relative strength chart. This is the chart relative to the S&P 500. So when it's moving lower, the S&P 500 obviously has strength. So no surprise from basically 2011 all the way until 2022. S&P 500 had strength. Predating that, the XLE ETF, and then same with from 22 to 23-ish, with obviously the Russian war and the price of oil surging. But we did see a reversal after quite a large move upward for the energy index, with the price of oil soaring from, I think, the high to mid 50s all the way at points to above 110. So really watching that for our energy exposure. And then looking here, this is the tech sector ETF. I mentioned tech gaining some strength. It's back to all-time highs, this ETF XLK. It was up about 16% in April. So quite a substantial move, which is reinforcing. Dorsey Wright wrote about cap-weighted exposure and tech regaining leadership. Obviously still important to have some tech exposure, even with some of the valuations in the market right now. Looking here, iShares, this is a different emerging markets ETF than we own, but it's a good proxy they used. But I just used it to highlight the support lines, the rebound that we've seen in recent weeks, and where we're sitting at the chart right now, fractionally off multi-year highs. You can see 2 boxes away from breaking that resistance. Really positive technical attributes here. And like we always say, really attractive valuations across the emerging markets. Crude, I kind of put some of these charts a little out of order. I threw some of them together a little later than the earlier slides, but I just wanted to highlight where we're sitting at crude. 2 sell signals in a row. Like I said, still trading in the 90s, which is positive. Still on this positive trend right now, but it did turn over in recent weeks with the price coming down from that, like I said, high 1 teens, 116, 117 at points. But still, we think their energy and some oil exposure still belong in investors' portfolios right now. Equities right now, with oil trading at the price it's trading at, really attractive. I mean, like Joe said, ceasefire was extended, but then later that afternoon, Iran reportedly seized 2 vessels. So who knows how much traffic's actually going to be going through the Strait of Hormuz right in the next, you could say, couple of months. And the couple months down the line is really when you're going to see the impact of less oil shipments and other energy products. Looking here, the countries obviously that have the largest strategic petroleum reserves. We always talk about the United States. As of March 2026, China actually has more in their reserves than the US, Japan, Europe, and all of the other countries in this top 10 right now. Or this is as of December 2025. So obviously, China, a net importer of oil. No surprise they have such a large stockpile, but potentially a wrinkle that could impact, obviously, the conflict with their stance in terms of their allyship and how they rely on the Middle East for oil. This is an interesting chart that the Bank of America put out of their research department, I think last week, that I saw. It just tracks the S&P 500, gold, and the U.S. 2-year rate. And they basically point out the price of gold is reacting to positioning and liquidity needs from investors, not just fear. With the price of gold obviously pulling back since the conflict began, yields moving higher, the S&P 500 recovering, but they basically put out that there's still some institutional demand from the central, or there's institutional demand on the investor side. Central banks still net buyers of the precious metal, but there are some positioning and rotation going on with investors with who are, I guess you could say, overexposed just with the performance of gold, silver, and even platinum last year. This is an interesting chart. Same newsletter, just tracking the real versus financial assets relative price movement, obviously all the way back to the 1920s. And the Bank of America just highlighted, even though Warsh mentioned yesterday that he wants to shrink the Fed's balance sheet, it's ultimately unrealistic right now. And the really only way that they're going to be able to finance that debt pile is potentially lower rates, which are very bullish for real assets, which is one of the reasons that we're continue to own real assets. And then I think this is the last slide, but just last slide on private credit. We've talked about this a lot in recent weeks with the banks all reporting their earnings last week. Wall Street, they have about 180 billion in loans to private credit firms. You can see how they're ranked. This is from Bloomberg, and the banks are raising the borrowing cost for these private credit funds, and they're also reducing the value of the assets which are being posted as collateral. That's going to continue to squeeze investor returns. These banks may demand their money back down the line if things really get murky, we'll say. But the problems could continue to get worse with investors potentially putting even more pressure on redemptions from these large private credit funds. And that's it for me.
Okay, so had a good bump on Bitcoin and the crypto exposure that I still have. I've got lower capital exposure due to the Iran war and the fact that I can't trust a single thing that comes out of Trump's mouth, right? Like, gonna end their civilization, and then it's like, oh, permanent ceasefire or, unending ceasefire. They don't know who's in charge. The IGRC runs the country. They're a self-funded military. That means that they're a quasi-government. They have their fingers in the economic interests of everything that Iran does. Uh, these guys, if they can get themselves sorted out, they will become the new sheikhs of the Middle East. But if this doesn't get sorted out, we're going to see this country break into the 32 regions, which was the decentralization plan of the original Ayatollah. And then we have a quagmire akin to Libya, Iraq, or Afghanistan. And there's absolutely no way that the U.S. is going to do a boots on the ground in Iran. Like, I mean, anything that they try is going to have to be very limited in scope, and would just be a massive disaster. We're not dealing with some country like Afghanistan. This is much more advanced, much more regional, with as challenging terrain. So investment themes right now, war is driving everything. There's seemingly some earnings going on, but they're in a limited number of companies, even though we've seen breadth widen out substantially. All eyes, in my opinion, should be on where is this inflation going to come through. The longer this goes on, the more the supply chain gets interrupted. The guys that use petrochemicals and petrochemical derivatives to manufacture things are burning through their supply. And we're probably now 2 weeks away from hitting the wall on some things. Asset classes over the past week, really not much to write home about, like oil up a little bit, gold down a little bit, but that's due to probably some US dollar strength. But Bitcoin caught a bid. They're trying to get this Clarity Act done. We'll touch on that. Economics, really no change. Like the US Fed going through the confirmation hearings with Warsh, they're just going to be dovish because we're facing stagflation, right? Right now, employment is holding up. It might even strengthen a little bit, but we do have an inflationary impulse moving through. And if that then affects wages and rents, then we are in a stagflationary environment because the structural containment of the ships in the Persian Gulf, it's not a demand problem. It is becoming a supply problem, and not just of oil, but all of these other derivatives that the world depends on: jet fuel, cooking oil, and on and on. Growth has slipped a bit by the Atlanta Fed estimates, and also global estimates of growth are coming down, and people are warning at the next bullet point, we're not in a recession now, but the risk is starting to rise. Anytime we've seen a 50% increase in oil, it has not done well for the economy going forward. The U.S. consumer, though, is just spend, strong retail sales, and if they drive the U.S. economy, maybe that's why the stock market hasn't folded here. Flipping over to a 5-year chart, normally we look at 1-year charts. 5 years, the dollar is kind of in the middle of the range where it's been over the last 5 years. It's neither here nor there, but expectations are for a lower value of the US dollar against most of the trading counterparts. Starting to wonder about, can the euro hold up against the US dollar given what's going on with oil? Gold, we look at a 5-year chart, still in a fantastic bull market. This is, maybe twice in an investing career that you have these types of incredible returns and high Sharpe ratio returns. The blip at the top was due to resetting the way they calculate margins, but it sure looks like demand is continuing. Silver, very similar, really got cracked down on the differential between spot and future silver in China, and then the exchange changing from being a dollar-based margin to a percentage-based margin. That is going to potentially cap leverage going forward. But the trend is very clear, and especially with this oil impact, the world can build solar. Nobody's going to, there's no Strait of the Sun, if you will. And the demand for solar is going to increase. China's the main producer. They need at least 100 million ounces per year. Oil, it's just all about war right now. But looking back to a 5-year chart, we've been at this level of oil in the past, and the world didn't end. We've got a global tax on consumers for a while. It's probably going to persist as the system works through. There's apparently 800 ships that will have to exit the Persian Gulf via the Strait of Hormuz, and they got to go unload and then come back. So the supply chain has really been impacted, but these strategic reserves have helped companies weather the storm. Now, strategically, if the US can get China to burn through all of its reserves, then it knows that, maybe it's not a good idea to attack Taiwan because we're going to get sanctioned and we won't be able to get gas. So I'm expecting $80 to $90 in oil price WTI for quite a while. Rates and credit, I've got really nothing to say here. I'm shocked at how quickly high yield returned. This was a huge rally, back to 2.85% option adjusted spread for high yield. And yet, headline, well, one of the front page stories in the Wall Street Journal is that the Fed is now trying to understand private credit. Just like before, they didn't understand how mortgages got away from them or CLOs, created credit. So they're not going to hopefully make the same mistake twice, but they probably will. US equity, just more greed. All systems are go. VIX got a great looking term structure. The earnings trend is still moving up, although from what I see on fewer and fewer names. The S&P is launched, as I mentioned in the last week's report. It's another ripping recovery. And if you look at 2022, the tariff tantrum in this, the symmetry of time from the bottom is just crazy to get back to all-time highs. Like, these are ripping rallies and have really served the buy the dip market. And that will work until it doesn't. This is like, I kind of say this tongue in cheek. This is unbelievable. We've had a big gap on the way up. We've blown past resistance. You can see the volume in the histogram over to the right. Like, we're well above that. We're printing new highs. We're above resistance. So resistance is now looking like it's at, 7,000 on the downside. Everything is a go. I'm just a little concerned that if earnings breadth doesn't really widen out, then we're really at the whims of Trump in directing sentiment. So I continue to say, hedge some now. This rally has been an absolute gift. Looking at the returns of, say, the triple Qs for the past year, up over 40%. Buy some put protection. Like, the further we are away from the mean return historically, the more you should think about this might not last, right? There's a return to mean in all markets. There's a gravity to things. And right now, I think 1 or 2% in put spreads is a smart thing where you can get a payoff of like 3 to 5 times. If we do dip down, even on the whole war drama, we only dip down about 9%. Well, you can make that up with these puts now after being given the gift of getting back to all-time highs. Crypto's looking good, but it's still broken in my opinion. These politicians can't get their act together, so to speak, to get this Clarity Act pushed through. They absolutely need it. It is going to happen at some point because the entire Treasury funding plan is based on Tether backstopping Treasury issuance when China and Russia and Saudi Arabia and the rest of the world no longer want to hold U.S. assets that can potentially be sanctioned or are going to be facing a weaker dollar going forward. Bitcoin, let's look back, 5-year chart, it's still done pretty well. But right now I'm looking at it and I'm in it deep, and it's like, who needs Bitcoin? Right now, nobody, right? We're not debasing the currency like crazy. And the question I have to ask is is a 40% drawdown enough pain for this asset? If you go back and you look at the beginning of 2022, we also had about a 38% drawdown. Things came up a little bit and then we fell down, and we were down 70%. So I don't love buying Bitcoin right here. You know, in the short term, if you're a short-term trader, knock yourself out. But structurally, I'm still not seeing enough clearance in the heat map and other things and political action to say I'm going to get back into this asset with both feet. And the cartoon for the day is a little subtle. When did this happen? You got to take a closer look at the stars on the U.S. flags. That's your hint. Anyway, that's it for me.
Hey guys, thanks for that. I'm not sure I have much to contribute because I'm as confused as everybody else. What the markets buy the dip is definitely the best strategy, right? Anything, whatever happens on the downside is going to reverse within 24 hours. You don't even have to wait a week to get a reversal. You just wait one day. And unfortunately, we're not very good traders, so we have not traded the market very well. And I'm finding it quite difficult to make money on a short-term basis. But we keep trying, right? Look, the one theme that we're pushing quite hard, because I find it just extraordinary, is these. We found 6 or 7 companies that are going to restart old mines, right? So in particular, silver mines, one or two gold plays, and a copper play. But basically, guys that are going to restart previous operations, and they're public, and they need money, and they've already got the money. Okay, so we've found 7 of these companies, and the valuations are just unreal. They have, if you believe management, right? So you believe they've got a plan, they're going to restart within the next 18 months was our criteria. And these things all trade at less than 2 times forecasted cash flow. Most of them trade around 1 to 1.2. So we find that extraordinary, right? So how are you going to make money in the silver business? How are you going to make money in gold? If just assume prices stay the same, but these guys actually put their mines back into operation, nothing's going to trade at 1 times cash flow, obviously, or 2 for that matter. I think everything goes to 6 or 7, right? And so I can flip you our little comp chart, but this is with the help of from 3 or 4 brokers, and I think it's just an amazing opportunity. So we put like 15% of the fund into these 7 names, right? So just to give you an idea, right, there's a company called Silver Storm, there's Sierra Madre, Silver Co. Mining. That company's trading at 1 times forecasted cash flow. Exelon, Silver Mountain, this Bunker Hill, and a company called 911, right? We've talked about that before. Gold 1911, going back into production, trades at incredibly good numbers, multiples. So I think that's the sort of, if you're looking for a safe play with lots of upside, invest in these soon-to-be producers. And so that's what we're doing. And we're reading the news every day and trying to figure out how to predict things, and it's awfully tough in this market. But I'm, Sean talked about buying insurance and all this stuff. Good idea. We're of the view that the markets are going up because they're going up, right? There's too much money chasing too few stocks, and that's not going to change. And the fact that the markets haven't gone down 20% with all the noise out of Iran is an incredibly bullish message. And we think there's a bigger risk that these markets actually do very well over the next coming months, as hard as it is to believe. So we're nervous about a move to the upside. Because very few people are expecting such a thing, and that probably means it's likely to happen. And the last thing I'll leave you with is one of our advisors is telling us that if you monitor the freight activity in the U.S., so travel, goods traveling through rail, planes and the trucking industry, everything is maxed out right now. That America is the industrial base is thriving, and so the onshoring is kicking in, building all these data centers. I guess all the capex, this monstrous capex that's happening, it's happening in the real economy, and that's extremely bullish for earnings and activity and business in general. So buy the industrials, buy any and all industrials. The stock charts are all breaking out to the upsides, and so you buy the transports and just basic fundamental economic activity in the U.S. is very strong, and that might be the other reason that the markets are ignoring all this geopolitical stuff. And tough to verify all of this, but that's what we're being told, and we're doing more work on that. So those are my few and useless insights for the day. That's it.
Can I just say the one thing on oil is, like, with oil at these prices, and what's not seen by most people, and I've heard this reported from former Glencore executives in Dubai, the spot market for oil is trading at a $30 and $40 premium to the futures market. So there's people now talking about, like, well, the government is directing blah, blah, blah to, like, hold down futures paper prices. But if you need actual oil to put into your refinery or into your processes today, it's trading at a huge premium. I got to think that makes every Canadian junior that's actually got production very valuable and very likely to be consolidated. Like, the margins, just like with the gold companies, the margins to these super majors are a gift. And if they can buy up companies and production right now, put it into their pipeline, and know that they are going to realize, like, potentially a $30 differential, they're just going to do it all day long. And I haven't seen that wave of consolidation hit. We're certainly higher on a lot of stocks, like up 25% easily since the beginning of the year. But I think it could go much higher, because I think these prices will be embedded much longer than anybody's thinking right now.
Yeah, I'd agree with that. M&A's coming, and M&A's coming in the mining, metals, and energy space for sure. There are deals being announced now every week in the mining space, right? So it is happening. And you're right, the Canadian energy stocks and whatnot are all very reasonably priced. Frankly, the international companies listed in Canada are even cheaper, right? So the Parex and Valoura, I mean, these stocks are so cheap, it's insane. So yeah, I would agree with all that.
Okay, good stuff. Hey, Paul, could you send the list of those 7 names and
Yep.
check them out for you as well?
Yep. I'll send you our little comp table today.
And no comments about marijuana this morning. Like, no one's excited about this news?
Well, we've been whipsawed in that industry 3 times, and I don't know. Not sure how to play it. The stocks are cheap though. I'll tell you that, right? The entire cannabis sector, all those big guys trade at about 5 or 6, maybe put in 7 times EBITDA. And they've got strong balance sheets, so they're not expensive stocks. So if Trump actually does something, they will double, all of them. So there's an opportunity, but hard to predict.
Yeah. Okay, thanks. Gilbert, you want to wrap up?
Sure. This is going to be a quick one this week. Here's a disclaimer. Short report, S&P 500 again did not come down to that level. It's been pushing up higher. We see 3 weeks very strong. Sorry about that. 3 weeks very strong, and so far this week it's been almost a bit of a pause here since then. Cape ratio, we can see that it was coming down. However, we've seen this very, very sharp reversal higher, and so now we're at the highest level again since the dot-com bubble, and it kind of stands to reason that we're going to be reaching for those highs once again. One thing to point out about this is that the trajectory here is not much more, but relatively more stable than what we saw in 2000. Credit spreads. This is actually from our the last meeting that we had, the credit spreads, and the reason why is because the Federal Reserve is no longer releasing this data. That you have to get it from ICE specifically, and so the only thing I want to point out until I can get access to that data is that this is a pretty strong wedge here. Yes, markets have pushed higher to new all-time highs, but historically, when we get back down to this level in terms of the spread between the credit spreads here, what essentially happens is that there's limited upside from there. Defense versus growth. I think we already touched upon this today. We're seeing a rotation back into growth, and it stands to reason again that we would see this move all the way down to those levels again. However, those are extreme levels on a relative basis historically. Market breadth. This green zone that we pointed out here with regards to the S&P 500 stocks trading above their 50-day moving average was, again, the near-term bottom. We've seen a strong rally off of that ever since. Looks like it might continue here, again, all things considered. But when we take a look at the broader market breadth, stocks trading above the 200-day exponential moving average, we didn't hit that level down there that we saw in 2025. In late 2023 and even in 2022, which signaled essentially longer term bottoms for the market. And so not necessarily saying that we're in a precarious position now, but it's not as bottomy as it might seem given the rally here. One other chart that I want to show here, again, this has to do with possibly why we're seeing such a strong rally, is that earnings per share revisions this year so far have been very, very strong compared to the average over the last 15 years. And so what we have here is just revisions going higher for the earnings per share. And so that's probably going to push this higher. As Paul pointed out, this is just a buy the dip market, right? It's feels almost like a blow off top here that we're going towards, but I guess we'll see eventually. If you are watching, you are concerned about what's happening in the market, please reach out to us. We have a solution with our partners at Universa. So that's it for me.
Okay, that's great. Thanks. Thanks, Gilbert. Anybody have anything else before we wrap up here? Nice and quick today.
Just keep an eye on silver.
Guys, did you guys see the silver numbers out of China?
Yeah.
The import from China out of silver running at 800 tons per month, double what it was for the everything, right? Going back monthly basis, going back for years. So the Chinese are importing as much silver as they can get their hands on. So yes, very interesting to watch, and we may get a spike in silver.
Yeah, that company Nord, which is up in Cobalt, Ontario, they closed that BMR acreage sale, and they're just waiting for receipt of the approval to start mining the tailings deposits there. They did a private placement to one overseas client for $2 million. There's going to be another raise here to domestic clients in Ontario. It's if you kind of read around the mining newsletters, it's sort of becoming obvious that Eric Sprott is starting to have his eye on some of these smaller kind of silvery startups. I'm not certainly saying Nord is one of them, but I do keep in touch with the Nord, investor relations VP, and there should be something, pretty nice for us to hear soon. The other one is Arizona Metals. So I talked to Morgan about a week ago, and she said the PEA 4K will come out before the end of April. Now, this is a PEA that has been delayed before. They did have some, I guess, communicational challenges. The issue isn't Duncan, Middlemess, or Morgan. The issue is there's a fairly big lineup at labs like SLR Consulting for studying the ore samples, and this is why our position in Paragon Geochemical, kind of was timely. It took off pretty good, and looks like it'll keep going. But if the PEA for K-Mine comes in before the end of April, which is what the management team is advising investors it will, it may kind of light a fire under that stock, because that thing's been getting crushed. And last time I checked, Paul, Michael Gentile is still easily the biggest or one of the top 3 shareholders. So we'll see. Nord is looking pretty interesting, though. It's still a very small company.
Yeah. With bad management.
Just a quick update. I don't know if anyone knows, but Avis is down another 40%. It just got halted.
Whoa! So, holy crap!
Yeah. So that's
still
just
wouldn't
going to
have
keep
been enough to make money in the put option market, though.
Yeah, because the implied volatility is so high, right? So it's crazy. But Avis has actually had a history of this. If you go back and it did something similar where it went up like 100% in a day, if I'm not mistaken. So
right. Well, it's gone.
This is another Wall Street bets driven short squeeze
Sure.
and unwind.
maybe.
Yeah,
Wow.
we're late to the party. Okay, is that it?
Yeah, I think that's it.
Talk to you later.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.